Now, moving on, the US economy is facing what we call a triple threat: the Iran war, tariffs, and ballooning debt burden. For Fed Chair Kevin Warsh, that creates a difficult balancing act. Tame inflation without further weakening an economy that's already losing momentum. So what is the Fed looking at, and how much room does Warsh really have to act? Take a look at this next report for more details.
Well, fuel cost alone has probably almost doubled from what it was last year. So that, it's made a very big impact.
Ahead of the high-stakes debut of Federal Reserve Chair Kevin Warsh at the annual Jackson Hole Economic Policy Symposium, the US economy is facing a triple threat. The Iran war is pushing up energy costs, tariffs are threatening to raise prices, and a $40 trillion debt pile is putting pressure on US finances. US GDP grew at an annualized 1.5% in the second quarter, down from 2.1% in the first quarter. Yet consumers have held up. Spending rose 3.4%, while business investment, excluding housing, jumped, largely reflecting the AI investment boom. But the Iran war has added a fresh inflation risk. Inflation is steady at 3.7%, way higher than Fed's 2% target. For the Fed, that creates a difficult trade-off. How do you support growth without fueling inflation? Then comes the second threat, tariffs, and Canada is at the center of the problem. The United States and Canada exchanged roughly $872 billion in goods and services last year. Canada also sends nearly 4 million barrels of crude oil a day south of the border, almost 20% of US petroleum consumption. Higher tariffs can mean higher costs for American companies and eventually American consumers. That matters because spending is already showing signs of cooling. In July, consumer spending rose just 0.2%, while spending after adjusting for inflation was essentially flat. And that leaves the Fed with another problem: weaker demand, but persistent price pressure. And then there is the biggest structural challenge: US debt. America's national debt has crossed $40 trillion. The government is already paying roughly $1.2 trillion a year in net interest, and borrowing is getting more expensive. Higher yields mean higher financing costs for Washington, and for American households and businesses, the cycle is difficult to break. Sticky inflation keeps rates higher. Higher rates keep bond yields elevated. Higher yields make the debt more expensive, and bigger interest bills add to the deficit. There is also a longer-term question around the dollar. The dollar remains the world's dominant reserve currency, but aggressive use of sanctions and trade restrictions could encourage some countries to diversify away from dollar-based systems. For Kevin Warsh, the challenge is therefore bigger than one interest rate decision. Iran, tariffs, debt, three pressures, one Fed, and a difficult balancing act between inflation, growth, and financial stability. Business Bureau, WION, World is One.